Good afternoon, everybody. My name is Philip Hargreaves. I'm Head of Access to Finance at GC Business Growth Hub. And this is the third of a range of webinars entitled Here for Business. This one is entitled Managing Cash and Costs in a Crisis. And as you will appreciate, is relating to financial aspects of the cost of living crisis, or as some people have named it, the cost of doing business crisis. Just by way of brief introduction, this webinar today will attempt to answer 4 distinct questions. Those are: what's driving the cost increases we see across the whole of society today, impacting on businesses? How is that directly relating to SME businesses? What can business owners do to tackle or alleviate rising costs? And what options and remedies are available to SMEs? I think I should say at this stage that we will be recording this session and it will be shared with everybody on the call later on this afternoon. It will be available for viewing on YouTube if anybody wishes to view this again. Just before we get into the webinar itself, just make some brief introductions of our guest panelists. I'm the chair. I'm Philip Hargreaves, as I said, Head of Access to Finance. Joining us today are Rupert Greenhalgh, who's Head of Business Intelligence at GC Business Growth Hub, and also Shalim Rahman, who's the SME partner at one of our core partners, Beavers and Struthers Chartered Accountants and Business Advisors, and they will both be presenting to you today. There will be a chance to ask questions as we go through the webinar, so feel free to put those in the chat box at any point and we'll endeavour to respond to those as we go through the webinar. Just before I bring Rupert in to talk about the causes of the cost of living crisis, I just wanted to share with you a brief slide that I pulled up from information provided by Andrew Bailey recently, Governor of the Bank of England, who states that 80% of the factors which are impacting on businesses in the UK are based on global factors impacting the economy. Those relating to COVID-19, the clearly microchip shortage, which, as you all know, is having a massive impact across a wide range of businesses, not least in the new car market. It's causing supply chain issues. Obviously, the war in Ukraine has had a massive impact on the worldwide economy, and obviously, as worldwide energy crisis is having a large impact. Factoring those into to the UK economy, looking at such things as labour shortages at the moment, UK salaries under pressure, raising energy price caps, and energy storage issues, and of course, rising inflation, all adding to the melting pot of what is probably a perfect storm in terms of our economy. So I want to hand over now quickly to Rupert Greenhalgh, who will talk you through aspects of the GC Quarterly Economic Review and what that impact is showing in terms of small businesses.
Thank you, Philip, and good afternoon, everybody. Hopefully it's not too much chalk and talk, or nor will it look a little bit like Rishi's briefing for his new economy as he starts to set out his new platform, I guess. So forgive me, there are a fair number of charts which I'll rattle through, but what I wanted it to look like is a little bit more like a management style report or takeaway, which I'm sure will be circulated after the presentation. So I want to just set a little bit of the tone around the national economic picture. The British economy, it contracted at 0.3% month on month in August 2022. I think the very earliest kind of leading indicators would also suggest we're going to see further contraction in September. The main changes that we've seen driving this change, which I think are important, is a decline in manufacturing output. Production fell by 1.8%, and of that, manufacturing declining in terms of output by 1.6%. Services went down 0.1%, led by, again, contraction in human health and social work activities. But I think one of the key things that we've seen this time is a significant fall in recreational spend within the economy. So consumers definitely tightening their belt. However, that said, in any slowdown and even looking at previous recessions, we have seen opportunities for growth. So again, some of these sort of contractions within the economy have been partially offset by growth in professional, scientific, technical activities, causing growth of 1.2%. But as you can see from the figures, a contraction in the month. The bottom right-hand corner, Standard & Poor's Purchasing Management Index every month, purchasing managers surveyed, and that's the composite PMI, which also shows a figure this time of below 50, and you can quite clearly see the significant contraction in the economy, a fall in the composite purchasing management index at the turn of 2020 into 21, when we were in periods of lockdown, etc. But the first time in some time, and we've seen it dip below 50, and 50 is a sort of net difference between balance of growth and contraction. So we're definitely in contraction territory, and you know that's leading to some of the growth projections for the year ahead, 2023, probably now being the weakest since May 2020 as well. So quite clearly we're now seeing, I think it must be, if I do my maths right, round about a 21-month low of 47.48, below the 50 mark is the latest figures. If we move quickly on, and I think your interest today is looking at what we're seeing in terms of rising costs for business. And there's no big surprises. The Bank of England, along with the Chancellor, are paying significant attention to the annual inflation changes. And indeed, in September, the figures were just above 10% for inflation, up from 9.9% in August. I think they're probably expected to be around about 11% by the end of this quarter. And I think within the long term, the inflation rate is projected to be between 6 and 7% in 2023, falling back to around about 3.5% 2024. But you cannot be exacting. What is clear, I think, from the inflation figures, as you see in the bottom right-hand corner chart, and if you're extending that time series back 40 years, you know, we've seen a significant high in July, 40-year high. And if you look in the largest contribution to that increase, and the sort of product groups which help comprise some of these changes, the sort of annual rate, there's no big surprise that energy and fuels have been one of the key drivers. But equally, I think you've seen on the BBC News today, forecast rapid rise in things like sunflower oil, pasta, etc., and bigger spikes that we're going to see, I think, in food prices. And that's driven also by those sort of production inputs, so oils, etc., but also the cost of chemicals and fertilizer, which seen significant annual rates of increase. I think what we have seen this later month is a slightly cooler price for motor fuels, etc., which has slowed inflation for sort of transportation within the economy. But however, you know, looking ahead, I think we're still going to see a slightly stoked inflation rate for a while. It's very difficult to be exacting, but I think all attention when the OBR publishes next forecasts and looks at its views on the inflation rates, that we're going to see those types of figures. Will there be increasing shifts in the base rate? Yes, I probably think there will be, given it's that high. We've already seen shifts previously by the Monetary Policy Committee and the Bank of England. We probably will sort of see the opinion continuing to surround increasing sort of shifts in the base rate. In terms of what the impacts of these challenges and risks that Philip mentioned on the economy, which I must also stress also include in part sort of challenges around the labour market and skills and talent attraction, retention and wage inflation, which I'll come on to in a short while. What are the sorts of risks? If we look at the Insolvency Office data and the impact on the economy, insolvency numbers clearly are rising within the economy. You know, that's part a rebound from those that survive longer and come beyond the forbearance and government support and benefits, etc. And the latest figures show quite a sharp uptick. Corporate insolvencies in the UK rising 16% in September compared to a year earlier. And what's the sort of batting rate? Or sort of average that out? I think during any deep recession, probably 5,000 to 6,000 insolvencies per quarter. The average rate in the last decade, I would say the batting rate's probably between 4,000 and 5,000 during the last 20 years, around 4,000 per quarter. And I think speaking to a lot of our partners who deal with insolvency risk, the rate's probably going to look above 5,000 per quarter, possibly even close to 6,000 per quarter for some time, if we move into continued stagnation in the economy and more difficult economic territory. So that gives you a little bit of a quick flavour. I wanted to sort of set the scene a little bit of what we're seeing in the national economy. I want to give you a picture of what we're seeing within local businesses since, before the pandemic, almost Brexit time. We've been tracking business sentiment with a business survey delivered by our advisors in the field, spoken to, I've not got the exact figure, but definitely above 9, possibly 10,000 businesses within the last 2 years for their opinions on a variety of things, including sentiment, about growth prospects, what's driving costs and risks, and what they'd like to see in business support. So I'd quickly like to tell you what they're telling us. In this chart, as you can see, we've seen a rise in input costs, and we ask the firms that have pointed this out as a key risk to their business. And it's been pretty inflated for some time. And I think what we've probably seen in the last 3 months of survey, you've still got that problem, that gnarly risk of rising costs, but slightly slower in terms of, and lower as an issue than has previously been in the last sort of year. I think the biggest and sharpest upticks we saw as we moved out of periods of lockdown as the economy opened up again. No big surprises at that time. There were also other gnarly supply chain issues. There's a block in Suez. There was a fire at the microprocessor factory in China. I think we've seen, as Philip pointed out, some of the sort of successive lockdowns in China and supplies again have affected costs on top of what we've experienced, a significant and sharp uptake in gas prices and energy prices, as well as fuels. But there's indication that that's slowing a little bit, but not slowing enough to dramatically fall back. We also asked firms about the supply chain problems, and the blue bars indicate those that I've said they're minor issues, but we can deal with it, and the green issue is more severe. And I think it's a good kind of map against when we've seen lockdown in the economy as well as some of those global risks. And again, those problems with supply chains, I think, are starting to fall back, which is some good news. But equally, what we have seen anecdotally, not helped by business travel difficulties to see suppliers, etc. And if we look at the sort of comparison to about a year ago, I think the position is better than it has been for some time, which is at least offers a little bit of respite from some of the other challenges, particularly those other energy price rises and cost rises that we saw in the previous slide. Now, we asked detailed questions about cash flow. Cash is king, cash flow issues and cash reserves. I think the good news is for business, particularly SMEs and larger businesses, and perhaps less so for micro-sized business, is that if you look by historic standards of the last 2 years, there is a lower proportion of firms that are saying cash flow is a problem for the business. And we've not seen any sharp uptick in cash flow risk. So if you look at, I think we're on around about 18% of firms saying it is an issue for their business, which is no small number, but it was probably 24.5% at the same time last year. And you see some of the peaks in cash flow as we emerged into lockdown prior to any government support. Now, if you look at that position, it definitely changes. Micro-sized firms definitely more stressed and twice as likely to report cash flow issues. But what we are seeing, I think, and interested on the next slide, is SMEs able to weather the storm, and also suggesting a hint that they are holding a little bit of cash, perhaps to hedge against the risk which might be coming down the track. So there's a proportion saying they've got cash reserves to last more than 6 months to stay in the business for that period of time. Is still probably one of the highest shares for some time. And there's a suggestion, I think, that at some businesses, like the UK Finance Survey, are holding cash just to hedge against risk and also hedge against some of these challenges that we've seen in cost prices. And finally, we also look at late payments. That's edging up, but no sharp cliff edges faced at the minute anyway. Businesses holding back payment a little bit longer to maintain cash. And there is variability in it's sort of cash hoarding and late payments and cash flow risks. If I was to look at the details, again, I've mentioned smaller firms, less than 10 employees, less than 250,000 turnover, etc. Definitely a lot more stress than larger SMEs, in particular those firms that are in hospitality, tourism, leisure, parts of retail, definitely finding conditions a lot harder with the steep price rises compared to other sectors and other sizes of businesses. We also look at the labour market, and very briefly, I won't go into too much detail, but within Greater Manchester, a batting rate of between 40 and I think 50,000 job adverts have been advertised in the last couple of months, live vacancies which remain unfilled. And more broadly, the UK, there's a commonly used term of the missing million. The labour market is 1 million less employees, and that is putting pressure on wage prices. Average salaries over time, in particular those in Greater Manchester, edging actually for September 22 slightly above the national average. And I think if we drill down into that data, we look at shifting wages and the types of narrative businesses telling us the skills, how to attract, retain, find within the market. There's no big surprises of experience across all occupations, but in particular sales, marketing, digital transformation, data engineers, definitely in demand, and probably seen some of the high sort of spikes in wage levels in the last year. And that again will equally put pressure on P&L accounts and the bottom line for businesses. So the missing million, probably the majority of that is due to increased economic activity. That's more people retiring, more people reporting ill health and moving out of the labour market, changes to migration, and some other minor issues such as this time of year, more people moving into and staying a little bit longer in education as people have gone back to university in September, October time. But yes, the labour shortages definitely have been with us and putting pressure on wages. As I say, I reiterate, sales, marketing, managers, leaders, specialists in digital data engineers and software development are probably some of the main areas of labour shortages and the ones I've seen significant hikes in wages in the last 12 months. So a bit like Phil's slide earlier, I just wanted to put a little bit of summary of what I think some of the main issues are. It's definitely a continuation of this volatile, uncertain, ambiguous situation. It's no easy thing for the new PM and Chancellor to wrestle with, really. I think we're for an uncertain year ahead. People are saying, will you be in a technical recession? Probably, but hopefully suggestions that it won't be long nor deep and able to come out of recession. I think consensus of economists believe that the global economy will probably just narrowly avoid a technical recession. We might edge into it, but again, hopefully not long nor deep as well. So hopefully that gives you a little bit of a counter through some of the risks and opportunities faced within the economy. I wouldn't like to sort of characterise too much, but what we're seeing total in the round, very stressed micro-sized businesses that are finding hard to face up to costs, SMEs that are able to hedge against risk and perhaps buy a little bit more time with cash, and then those that every recession studies have shown people can capitalise on opportunity and growth. Around 1 in 10 firms within the previous recession were able to capitalise and demonstrate sort of growth, whether that was developing new markets or growing quite quickly within the economy. So hopefully giving you a little bit of a flavour of some of the things we're hearing and seeing from businesses set within a national context. And I'll pass you over now to other presenters who'll talk you through what businesses are seeing and what they can do about managing and looking at costs and risk. Thank you.
Thank you, Rupert. I think we had a slight issue with your microphone as we went through that, but I think broadly we were able to hear what you were saying. But just to make it clear to everybody that the slides will be available to review at your leisure in those detailed slides, so they will be shared with you after this event, so don't worry if you didn't quite catch everything that Rupert said. But Rupert, thank you very much. Are there any questions, Ben? Do we know if any questions have come into the chat at this moment for Rupert? No, so no questions yet, but feel free to drop any questions into that chat as I mentioned. I want to call upon now Shalim, who's going to really put some of that meat on the bones about what business owners can do themselves, to tackle or alleviate some of those rising costs and some of the impacts of those things that Rupert was talking about. So Shalim, over to you.
Thank you very much, Philip. Good afternoon, everyone. My name's Shalim Rahman. I'm a partner at Beaver and Struthers Accountants and Business Advisors at the local in Manchester. And my department deals essentially with SMEs from the micro sort of lifestyle businesses turning over just a few £1,000s right up to the multi-million-pound turnover businesses. So it's real variety and lots of sectors. So I'm seeing lots of information and data from all types of businesses. So it's been very interesting to sort of like see what the last sort of like 18 months have done and trying to predict really where the next 18 months is going. So I'm just going to have a look at sort of like what SMEs can do to tackle the impact of rising costs that Rupert sort of like detailed on his slides. A lot of it is to do with the macroeconomic situation and the international situation. So we're all in it together. Lots of countries are in it together. It's not just the UK that are suffering here. But I think a sensible place to start is looking at cash flow. And Rupert's slides show that the UK SME sector is doing quite well at the moment. It seems to have more than 6 months of cash flow available, which is a very healthy situation. And that's typically what we, as accountants, advise when you're going into business as a startup. Try and have about 6 months cash flow to get the business through those early hurdles. So that's really encouraging to see. But generally, cash is king. We've all heard of that. And I think the key to like understanding cash flow is to really drill down into your cash cycle. And what I mean by the cash flow cycle, a definition is the cash cycle is the time period taken between when a business pays cash to its suppliers for the stock it receives, ultimately converting into the cash it receives from its customers. So you're looking at the timing between when you're paying for your stock to when you actually receive money from your customers for that one piece of for that one widget, for example. So that varies depending on the industry you're in. So something like a farm would have potentially a longer cash cycle than someone who's just buying and selling electrical equipment sourced domestically, where they can buy it and sell it within a couple of days. A farm, you've got to actually plant stuff perhaps or rear stuff, and then you've got to harvest it, and then you've got to package it up and then sell it. So that can be, in some cases it can be months. So really understanding your cash flow cycle gives you a starting point. And then what you're trying to do is sort of like forecast that and figure out, okay, where are you going to have sort of like problems potentially with your cash flow? And your forecast as a minimum should be the length of your cash cycle. So, if it's taking you 2 months to convert your cash from purchasing to sales, then your forecast needs to be at least 2 months. Typically, businesses do 6-12 month sort of cycle cash flow forecast. When you go beyond that, it's a little bit sort of like long-term cash flow forecasts are a little bit they can be pie in the sky, but they do help for strategic decisions. But the key bit at the moment, I think, is short-term cash flow forecasting, short to medium term. So what goes into your cash flow and how can you improve it? So just flick on to the next slide. We've mentioned debtors, creditors and stock are the key components on here, and the forecasting software is out there. And the good thing about forecasting software, in the past as an accountant, I used to see clients spending a lot of money to get some forecasting software built for them, bespoke, or using spreadsheets that were prone to error and very easy to get a cell deleted and suddenly the cash flow doesn't make sense. Well, these days there are loads of very inexpensive what we call apps, a bit like in the Apple world or the Android world, and these add on to your cloud bookkeeping software, and they essentially make cash flow forecasting extremely simple and really useful. And they are dynamic, they're live, they move with the current information in your accounting system. So that's one really good sort of like progression we've made in the last few years. So if you're looking at the different sort of components of your cash flow, you're looking at essentially the big impactors on cash flow are your debtors, your customers, your creditors, people that supply you, and stock if you're a stock holding business. So, there are businesses that don't hold stock. As accountants, we don't really hold stock. Our key cash flow is essentially our staff wages and business overheads. But traditionally, these are the three sort of main components. And I think if we start with debtors, so this is the sort of time it takes to get your money in. Often what I see are that people aren't invoicing straight away for their sales. And you notice a huge difference if you have timely invoicing for your sales, and there's lots of ways to automate this. The chance you're getting paid are obviously sooner because the invoice has gone out immediately. Often I see people invoice at the end of the week. I've even heard of businesses invoice at the end of the month, which I can't quite understand in this climate. So invoicing efficiently and on time is a huge deal. And then actually chasing up when they're getting towards their payment terms. So, if you offer someone payment terms, it may be cash on delivery, it may be payment within 7 days, 14 days. Typically in the UK, 28 days a month is fairly normal for businesses. But businesses often go beyond that. And if you don't push them, they'll drag it on to 60 days. And so the onus is on you to actually make sure you collect it within the 30 days. And there are software applications out there that will actually send out automatic reminders to your customers, asking them to pay. And once they've paid, it will confirm to them that they have been paid and will let you know they've paid. And this will basically save your time in chasing your customers and your debtors. And this is massive. A small point here, offering a prompt payment discount. So this applies to both you offering it to your customers and you sort of like accepting it from your suppliers. And it may be as small as 2 or 3%. And you probably need to weigh up the fact that, okay, 2, 3, or even 5% I've seen payment. So this is asking your clients to pay either early. If they pay within 7 days of receiving the invoice rather than say 14, you offer them a fairly attractive discount. The benefit of that is the cash is coming into your business and you can then churn that cash and use it elsewhere. You can also save on any finance costs that you might be using to basically for your working capital. So this might be an overdraft that you don't have to dip into for as long, or a discounting facility which you're not having to utilize. So churning that cash as quickly as you can, it can save finance costs and let you free up that capital. That's where a prompt payment discount, even though it's going to hit your bottom line, because it's 2% or 3% coming off your bottom line, it might actually save you a similar amount in terms of finance costs and the opportunity cost of not being able to use that money. So that needs to be borne in mind. So I think the message here is to essentially ensure you invoice as quickly as you can when you dispatch items, provide a service. If you can get onto I think businesses these days are going onto a subscription type of service. So as accountants traditionally would invoice at the end of the year once they've done the accounts. But we're doing things during the year, and you may find that you're doing things, particularly if you're providing services, you're doing things during the year, but you're not invoicing for them. You wait until the end of the year. Well, why don't you just flip to monthly invoicing on a direct debit? Direct debit, sometimes it's difficult to set up a direct debit with banks because there's lots of paperwork and stuff. There are third parties out there where you pay them a small amount and they will set up the direct debits for you, which gives you the control. So I think if you can get regular invoicing in, regular cash flow, that's a really good way of giving you sort of like control and letting you plan your finances. You don't need to have these long periods of not receiving cash. Now, on the creditors side of things, I think, as you do with your own personal finances, you are looking at getting best value for money. And, I think everyone, in the last sort of like couple of months, definitely have been reviewing their personal expenses to see where can we save money. Do we need to use, do we need to pay for all those Sky channels? Well, I've cut one section out because I never used it, but I just had it because it was bundled up and I'm saving some money there. And I think you need to have a critical look at all your expenses. And, you're talking about your cost of sales, by which I mean your direct costs, which are typically costs of materials, direct labor costs. You really need to review and see, are there better prices out there? And I think that could bear a lot of fruit. Again, prompt payment discounts. A lot of suppliers will do the same. They will offer a discount to you for settling up early. It benefits them. It could benefit you. You need to weigh up, does that make sense from your perspective to get that discount? Sometimes it works, sometimes it doesn't, but it's definitely something to ask for. Perhaps if you're not being offered it, ask your supplier, if we pay you a bit earlier, can you give us a discount? And often they will say yes. One interesting point, I think, with COVID and Brexit, supply chain difficulties with like shipping and transportation, getting goods into the UK. I've seen a number of clients look for suppliers that are local to them, so they don't have to have these very long lead times, and shipping costs, from what I can see, have gone up maybe 500, 600, 700% over the last 18 months. It's been horrendous. So it's now making it actually feasible to source locally, because before you couldn't buy locally because it was so expensive. You had to ship from abroad. But with a 6-month lead time and with 800% increase in shipping costs, perhaps it's the opportunity to see if you can get some from the UK market or near the UK shores. And I've seen clients do that. And basically, what they can do then, they can just hold enough stock that they need. It's almost a concept that very similar to just in time. That was, I think was fashioned by companies in Japan, where effectively they just held what they need and freed up working capital because they had a local supplier and it was a strong relationship. They could pick off the stock as and when they needed it. So that sort of moves on to the sort of next slide quite nicely, in that essentially strong supply chain is going to give you the best deal. And I think freeing up working capital, as in not tying up your cash in stock, is the ideal scenario. You've got to keep a minimum level sometimes, whether it's for certain parts, there might be some regulations, but really monitoring that. And there's loads of applications and you can automate that. And I will touch on automation a little bit further on. So just moving on here, I think we've touched on this about reducing non-essential costs. It's looking at the best prices, haggling. We're not the most famous nation for haggling, but when you go on holiday overseas, you have to haggle a lot for prices, and there's no reasons business shouldn't haggle. I think we need to haggle a lot more for prices, and you'll be surprised perhaps how often you can get a discount from that. Automatic renewals, we're all guilty of this. I'm guilty of this. I just think, yeah, get an automatic renewal for my insurance. I'll just do it because it's convenient. Well, actually, hidden within that is you've lost the discount for a new customer, which if you just ring them up again or do another application, you'll get that again. So it's not being lazy. Look at, critically review all your subscriptions and licenses and see if you can basically get them elsewhere. But the chances are you're going to get them cheaper than an automatic renewal. So yeah, just look carefully at that. And outsourcing costs. It's an interesting debate, but do you outsource or do you keep it within? And I think you need to evaluate, because at the end of the day, what our biggest labor cost, our biggest cost is our labor cost. That's a huge part of our business costs. So for lots of businesses, labor is a big cost. Now, if you're outsourcing certain activities because you don't have expertise, that makes sense. But if there is some stuff you could do in-house and you've gone through your staffing and they've got some capacity, well, use that capacity, maybe redeploy them to do certain things that are being currently outsourced. And I think you're just looking at chipping away at expenses one at a time. And when you aggregate them, the savings can be quite significant. So just moving on, premises review, looking at costs again. The COVID scenario, which brought in working from home and hybrid working, which lots of businesses are doing. Beaver and Struthers as a business are hybrid working. So we're in the office a few days a week and we work from home a couple of days a week. Not all of us are going to be in the office at the same time. Lots of businesses are in the same position. Do you need to maintain the same office space that you had before? Not so easy if you're in a lease because you're committed to a certain length of tenure. But if you're in a lease, can you sublet? Can you check your lease? Will you be able to sublet some of your office space? I have a number of clients who have actually sublet part of their office spaces, and it's allowed in the lease, or they've gone to the landlord and they've had the lease varied. Okay, they've paid for that variation to get the lease done, but it's worked out way more beneficial than leaving it as it was and not having it sublet. So that's one thing. And then, of course, if you're coming towards the end of the lease, or if you own the building, perhaps consider downsizing to a smaller hub-style operation where you can hot desk. The cost savings can be fairly significant there, and that'll free up cash, which could potentially be invested or could pay down some debt and reduce finance costs. So a couple of options there. We've gone on to we've already discussed reviewing staffing costs, essentially outsourcing or not outsourcing, using freelancers and subcontractors perhaps. One big benefit of using freelancers or subcontractors is that they give you flexibility. When you take on employees, you're gonna essentially have a fixed cost that's there every month, typically on a salary, and they accrue employment rights to your employees. And they're not, you can't let them go and bring them back on. Just can't just turn on the tap and turn it off. You can do that with subcontractors and freelancers. So I think if your business is in a sort of a project-based type of business where you have projects, then there is a lot of merit in looking at the subcontractor or freelancer market. Sometimes it may seem like it costs more because the rates they charge are higher than employees, but actually over the long term, it will save you because you don't have idle subcontractors when you're not as busy. So I think that's a very flexible part of the labour market that should be looked at. And budgeting, very important. You should have a budget set out so you know exactly what your cost should be for every single line in your, what we call the general ledger, your nominal ledger. So your accounts are made of all your cost lines. You should have a budget against each one of those. And if they go up, you need to query why they've gone up. And you need to stick to that budget. And there's far too many businesses that don't operate a budget against actual look at the variances. And it's very simple to implement. And the software these days allows you to do it very straightforwardly. And I think quickly moving on to technology and innovation, I've been talking about software and applications. That's been the big change. I think they call it, what are they calling it? The fourth industrial revolution or something like that. But there's so much that's happened in terms of accounting and the app ecosystem. And you can automate lots of things, such as stock management. We're using barcodes. It automatically gives you a stock number. It'll reorder stuff for you. It'll find out who your cheapest supplier was. The key thing here is that it's freeing up your time or your stock manager's time to basically focus on the business rather than looking at paperwork and spreadsheets and trying to do that. And the great thing is, these tools are out there, and some of them only cost like £20 a month. In the past, we had clients who were using like a Sage desktop bookkeeping solution. They had to get a program written that cost them. I remember one of my clients spent about £8,000 to get a stock program written. Well, you can go and buy a much better one now for probably £100 a month. So that's technology. That's how it's gone. I think getting your money in, I put enable card payments, direct debits to be accepted. Having a simple payment button on your website, or when you send an invoice out electronically, pay by Stripe, pay by PayPal. All right, there is a charge there, but the chances are you're going to get paid a lot sooner because people just go and click on it and pay it rather than having to go through and do a bank transfer, load onto their banking. So simple thing like that, we've seen evidence that it does quicken the time you get in terms of receiving money from your customers. Data, your systems contain loads of data, and it's all about data these days and how to basically use that data, manipulate that data, get the most out of it, leverage it, and work out what do you need to be doing from that data. And there are tools out there that can extract that data, put it in very nice sort of like readable dashboards that you can access very simply. This from your accounting data, and it's giving you loads of sort of insightful information that you can act on. And you just need to perhaps spend a little bit of time with a business professional who can just tell you how to interpret these. And it's the way that I think businesses are going to have to adapt and really sort of like make the most of their existing client base and see where they're going wrong, but see very quickly, because it's live data and it's real-time information. You don't have to wait for your accounts to be prepared, 3-4 months after the year end, and then say, right, that's what happened. You can do it live, and that's the key thing here. So the key thing here is to look at improving productivity, and I think the sort of like the expenditure on technology applications will see an improvement in productivity. You're going to get more out of the average person. in terms of the output, that's going to lead to a lower cost per unit and therefore increased profitability and increased cash into the business. A couple of other points here: transport costs. Electric cars are the biggest sort of perk at the moment we're seeing as accountants. Before, company cars cost a fortune. Potentially, you could have £100,000 car as a company car, and you pay 37% benefit in kind on that. You can have a £100,000 Tesla and pay 2% benefit in kind because it's electric. Now, you may want that as a company director. It's going to save you loads and thousands of pounds in tax, but you may start offering it out to your employees to keep your employees. The labour market is very tight. We're having problems recruiting. The whole accountancy world's having problems recruiting. If you can entice employees to stay with you, offer them things like electric cars, charging for free at work, which is tax-free for them, that's an incentive for them to stay. It's not all about paying them the higher wage. So I think electric vehicles are definitely a thing to look at, definitely at the moment anyway. And investment, if you're doing investment and you're looking at innovating, R&D tax credits are fabulous. You're getting enhanced relief. You can even get cash back from HM Revenue and Customs for money that you've spent developing something. And it's not what everyone thinks. You don't have to be doing something wearing goggles and a white lab coat. You'd be surprised at what you can claim R&D for. We had a client doing window frames, and they just had a different technology for the seal, and they didn't have lab coats and stuff and any of that. They claimed hundreds of thousands of pounds of R&D tax credits, and it's something that I didn't even think about was possible. So it's worth speaking to your advisor to see if you qualify for R&D tax credits. Very quickly, because I know I'm running over, and I apologise. Voluntary VAT registration. People think, why would you want to, if you're already VAT registered, it doesn't apply. But there's lots of small business out there that aren't VAT registered because they haven't hit the £85,000 limit. Well, that's understandable. You don't have to register because you've not hit the limit. But it can actually be really advantageous, particularly if you're in a B2B scenario. So if you're dealing with businesses generally, but you're not VAT registered, well, if you register for VAT, you are not making yourself more expensive by being VAT registered, because your customer, which is a business, will recover it. The key thing for you is that you can recover all the VAT on your costs, and that is significant. So being VAT registered is actually pretty sensible, and we do lots of voluntary VAT registrations for businesses from day one that haven't even started trading, and we apply for a VAT registration. One other good thing there, it hides the size of your business, because if you're not VAT registered, everyone knows your business is below 85,000 or you're breaking the law. So by being voluntary VAT registered, you can give the perception your business is actually bigger than it is. And in business, a lot of it is about perception. And also, don't start on invoice number 1. Perhaps start at invoice 1,000 when you start your first invoice. And I think we've talked about retaining staff. Empower your staff. Let them understand the cash cycle, because if they appreciate that actually, if they can collect money quicker, then it really impacts on the business, and potentially, they'll get rewarded down the line. That's great. Don't just keep it stored up as the business owner. Try and educate the team, whether they're purchasing or collecting the cash in from your customers, the importance of getting that cash in as soon as possible. It'll benefit them and it'll benefit you. A great thing to do is to make sure your credit rating is as best as it can be, because your credit rating will affect your costs, because you can't get financed at such a great rate if you've got a poor credit rating. So keep within your credit limits and make sure you pay within terms. And if you can, file as detailed a set of accounts as you can, because the credit rating agencies, I don't know how they do it. They use these weird algorithms, and sometimes I'm surprised when we put a really good set of accounts to go down. But the credit rating agencies can only work off the data provided, and sometimes you can get a thing. There's a set of accounts called micro entity accounts, FRS 105, and they show very little information. And we don't really advocate filing those because there's nothing you can latch onto. So the credit rating agencies, you may have done really well, but they can't figure it out, and you don't get the bonus. So try and file the next setup, which are called they're called FRS 102 accounts, and you can send a sort of a shortened version of them called filleted. If you're not filing filleted accounts, look at doing that. There's a chance they could enhance your credit rating. And I'm hoping I'm wrapping up here. I think sales prices, it's an obvious push your sales prices up. We looked at costs, but at the end of the day, the key bit here is the bottom line, is the profit. So look at push your prices up, but make sure you communicate. Weak pound at the moment, exports are cheap. Try and monopolize, capitalize on that. Online presence, e-commerce stores. We've seen so much happening over the last 2 years with clients developing, pivoting where they're going and looking at sort of the e-commerce and the online side of things. So yes, finally, I'm there. So thank you very much for listening to me.
Thank you, Shalim. That was really informative. A lot to squeeze into that short space of time. And who knew when businesses came on here thinking about the cost of doing business crisis, you would encourage them to buy £100,000 Tesla. Hey, every day is Christmas Day. One of the people on the screen who have not introduced, so I do apologise for that, is one of my senior colleagues in Access to Finance, Ian Dixon. And Ian, I don't know if you've got any questions to raise at this moment in time or any comments that you want to make. There's no pressure to do so if you don't want to, but the opportunity's there.
Yeah, I think a couple of observations, starting with perhaps reflections on Rupert's initial presentation. I mean, certainly from my point of view, what I see is a real difference in the current economy and the potential recession to that which we've seen in the past. And one of the key reasons from my perspective, I see SME balance sheets much weaker than we've seen them in the past. Now, I know during the pandemic, many SMEs had what might be construed as artificial support through some of the, the lending schemes, be that furlough, C-bills, B-bills, etc. But I think the pandemic undoubtedly has had a significant negative impact on balance sheets. So moving forward, that's going to severely constrain a lot of businesses' abilities to refinance, raise investment in terms of the future. So that's a key consideration. Reflecting on Shalin's presentation, I mean, a huge amount of content and, tactical, interventions that can be made. I always like to think of cash flow on almost 3 timescales: the very short term, the medium term, and the long term. And by immediacy, I'm talking about things you can do over the next 30 to 60 days. Typically, the medium term, probably 60 to 180 days, and the longer term, 180 plus. So I think for any SME owner looking at their current liquidity, cash situation in the business, I always urge them to start with understanding what the balance sheet looks like, because it's amazing how many businesses we interact with where actually there is cash on the balance sheet. It might be sat within debtors, it might be sat within stock, etc. But there are immediate actions that can be undertaken. And, Shalim's already identified some of those, and those can have that immediate effect on your business. Some of the more process-orientated changes tend to be what I think of in terms of medium-term implications on the business. And then the longer-term implications, exactly what Shalim's talked about, might be, re-engineering the supply chain at another level. It might be restructuring the business or refinancing the business, etc. And I think it's really important that all owners focus on the 3 timescales, and that strategies almost are put in one of those silos. And then that gives you almost your list of priorities to work towards, Phil. And one thing that Shalim did mention that's absolutely critical internally and really is overlooked by a lot of entrepreneurs, a lot of business owners, is the need to communicate internally on where that focus is. So it's not just the management team, the senior leaders within the business having the focus on the cash flow. It's making sure that that's communicated to your frontline workers, those engaged with customers, those engaged with suppliers, those engaged in the production, the manufacturing process as such, and that they understand why that currently there may be constraints on cash, or there is a need to preserve cash in the business. So for me, communication is a really, really powerful tool, and again, one that's often overlooked by business owners.
Okay, thank you, Ian. I don't think we've got any questions as yet, so I'll push on. I just want to talk a little bit about the fact that we've talked a lot about what businesses, what's impacting the economy, what's impacting small businesses, and what businesses can do. But I think it's important to understand that help is out there. There is support available. Professional advisors such as Shalim, obviously, he's talked passionately about what the accountancy profession can do, and I think SME owners, often in small micro SMEs, are often pretty much out there managing businesses on their own, and often it's difficult to know who to make contact with and who to reach out to. So I think this slide is about reach out to professional advisors, reach out to maybe trusted friends and colleagues and mentors who will be able to help and guide, and at least be there for business owners to bounce matters off. Speak to the chambers. Many people are members of the chambers of commerce. Obviously, many people are part of membership bodies such as the Federation of Small Businesses and CBI. I'm going to spend a little bit of time talking about GC Business Growth Hub, so I'll be quite indulgent about what maybe the access to finance service and some of the wider services in GC Business Growth Hub can do. And Ian mentioned about maybe restructuring professionals, and if the worst comes to the worst, maybe connecting with insolvency practitioners, and that's obviously something that comes further down the line. Thinking about the access to finance service, and these are Ian's slides, and he talks about these all the time. We have two key objectives. We are here to support SMEs to become investment ready, and that means a lot of different things to a lot of different people, but effectively it's helping businesses to tell the story to a financier, to someone that's going to potentially either invest in your business or put funds into your business. And it's really making sure that you've got your ducks in a row, making sure that your financial forecasts are relevant and appropriate, making sure that your business plan is relevant and up to date, and making sure that you've got the best chance when you put your business case in front of a financier that they are able to say yes and not to give you the easy no. And another core part of what we do in the access to finance service is introduce businesses to appropriate funders, so the right funder at the right time for the right business. And we've got, I guess there are five key pillars to the access to finance service. One is, it's, as we like to say in the public sector world, it's fully funded, which means it's free to access at the point at which we deliver support to SME businesses across Greater Manchester and in fact across Lancashire also. We are impartial and independent, so we're not tied into any specific funders. We help to introduce you to funders that are right for you and right for your business. We like to think we've got wide-ranging credibility across our advisor groups. We have many years experience, many of us having come from commercial and corporate banking, and some of us having come from the accountancy profession. In fact, some of us having owned and managed and operated businesses in past lives, if you will. And we are complementary. We don't try to get in the way of existing funders. We work with a lot of high street banks and help businesses to understand how they can access additional funding through that bank, or maybe complementary funding through other forms of funding. And we do have links to other business support programs. We're not just an island in the sea. We support businesses across a broad range of areas across the Growth Hub. One thing I just wanted to plug, if that's the right thing, is our Finance Simplified cohort program. So what that effectively does is take some of the messages that you've had from Rupert and Shalim and myself and Ian during the course of this last 55 minutes and focuses more on some of those aspects, looking at things like an introduction to finance, how you prepare to obtain finance. Understanding financial statements is a key aspect, and Shalim talked about that in detail. How to manage your finance, the impact of digital accounting, which again Shalim talked about, and then core aspects of what the sources of funding look like and how you can access those, whether it's debt finance, whether it's equity finance, as part of your funding strategy. So all these details are available on the GC Business Growth Hub website. So I'd encourage you, if you are a small business, if you are struggling with the cost of living crisis and you need to better understand how you can manage your own business going forward, then I'd suggest that you do contact us through GC Business Growth Hub, and maybe contact Shalim and his colleagues at Beaver and Struthers as well. I just said we'd talk about some options and remedies, and there are flexible finance options out there. It's not just about high street banking. It's not just about loans and overdrafts. There are flexible finance options such as invoice finance, which can help businesses strategically to move forward. The one thing we always say in Access to Finance is keep your existing funders in the picture. Give them the good news, but also give them the bad news. Help them to understand what the problems are that are impacting you and your business. And in that way, the chances are that they're likely to be more sympathetic and more supportive and more helpful. We talk also about blended funding options. It's not just about one-stop shop like it used to be for high street banking, probably when I started in banking 40 years ago. But it's about looking at a range of options across the marketplace and making sure that you access that range of funding options. Shalene and Ian have already talked about actively managing cash and cash flow. Be on top of it. Don't allow it to manage you. You manage your cash flows. I've put down there, search the market for grants. There were grants available during the COVID pandemic. There are fewer grants available at the moment, but there still are grants available for the right kinds of businesses. Ian talked about turnaround and restructuring, acknowledging that maybe the business is not in the best of health and you might need some key help and support with that. And of course, in certain circumstances, there are insolvency practitioners who are there to help protect the business and also protect the individual position of directors and shareholders. So there are lots of remedies and options out there for businesses, but it's key that you do talk to professionals and help to get that help and understanding that you might need to take your plans forward. But as I think Ian said, the option is not to do nothing at this stage, because that's a critical option which will see businesses fail and decline. I think the Federation of Small Businesses said it expected up to 500,000 businesses to potentially fail during this cost of living crisis. And the one thing we want to make sure is it's not your business. Navigating the finance landscape can be very difficult. And whilst Access to Finance can be a point of contact for that, we're not always able, or is it appropriate for us to delve directly into the support that businesses need? And we can certainly help to signpost, provide tips and guidance about where businesses might receive that. We can help many businesses, but in some instances we will be signposting out to other organizations such as restructuring specialists, etc. So I think the overriding message from today is, there are problems with the economy. I mean, Rupert's talked about those. Shaleem's talked about some of the options that businesses can take to overcome some of those problems that have been caused, by worldwide economic conditions. And the message from me in Access to Finance and my colleague Ian is that there's always support and help available, whether that's in the private sector or whether it's in the public sector. But the thing that business owners have got to do is make sure they access that support and help and guidance. Okay, that's the end of our session for today, unless any of our speakers would like to make a further comment. Not at this stage. I don't think we've got any questions. Oh no, we do have one. What size should a company reach before a full range of services are available? Do you want to pick that up, Ian?
Yeah, in terms of full range of services, I'd really need a better definition of what that is, Phil. I mean, what I always say is the Business Growth Hub is a fantastic repository of experience and knowledge. And I think, as you've already highlighted on the previous slides, Phil, chances are, if the answer is we don't know, we do know where to find the appropriate source of support for you. What I would always encourage, and I've had an instance with a client this morning where the response to most of my questions was, well, we don't know because we've not got up-to-date data. And I think, Shalene highlighted in his presentation the importance of having up-to-date financial information. This particular client, interestingly, was in an invoice discounting facility. Now, actually, probably that facility, there are plenty of actions they could take to improve the liquidity within that facility. But the problem is they don't really understand how it operates, and they don't understand what their particular up-to-date position is with that facility. So, regardless of whatever route you want to go down, you always must have up-to-date data, and that's almost a prerequisite. Without that up-to-date data, it's often very difficult to signpost quickly and effectively to the best possible support in the marketplace, Phil. So it's a good question, and really highlights the importance of having that management information up to date, or certainly in the process very quickly of being brought up to date.
Okay, I don't think any more questions. Our next event under the Here for Business webinar banner is about reducing costs, enhancing efficiency, improving productivity and maximising profits. That webinar takes place at 9 a.m. on Tuesday, the 1st of November. So visit the businessgrowthhub.com website to book your place. And certainly, if anything we've said today has touched a nerve with you and you're interested in taking things further, then certainly access the Access to Finance team and wider hub services through the businessgrowthhub.com website. And that's the end of the session. It just remains for me to say thank you very much to Rupert, Shaleem and Ian for their involvement in the webinar today. It's been much appreciated. I hope everybody out there listening and watching has found it entertaining and more importantly found it helpful. And I'm sure if we all pull together, we'll get through this cost of living crisis as we did in the main through the COVID-19 crisis that we thought we'd seen the back of in terms of economic impact. So thank you very much, everybody. And that's the end of the session today. This recording will now stop and will be placed onto the Business Growth Hub's YouTube website, and you'll receive a copy if you've been a member of the audience today. So thank you very much.
Thank you, Philip.
Thank you, Philip.